Every dollar in your wallet was born from debt. Every bill you earn, every coin you save, every payment you make, all of it started as someone's promise to pay back money that never actually existed until the moment they asked for it. This isn't conspiracy theory. This isn't speculation. This is the fundamental architecture of modern money hidden in plain sight, and the implications are staggering. Most people think money is created by governments printing bills or minting coins. They imagine vast treasuries filled with gold, backing every dollar with something real and tangible. But that's not how it works. Not fact even close. Physical cash, the bills and coins you can touch, represents less than 3% of all money in existence. The rest exists only as numbers in computer systems, created not by governments, but by private banks every time they issue a loan. Here's the shocking truth. When you walk into a bank and ask for a mortgage, a car loan, or even a credit card, the bank doesn't lend you money that already exists. They create new money out of thin air, simply by typing numbers into their computer system. Your promise to pay it back, your debt, is what gives that money its existence. Without your debt, that money would never have been created in the first place. And this system, this debt-based creation of money, controls everything. It shapes how much money exists, who gets access to it, and what happens when the debts can't be repaid. It's the reason why debt keeps growing faster than the economy itself, why inflation is baked into the system, and why financial crises seem to repeat with clockwork precision. Every dollar is born in debt, and that birth certificate comes with consequences that reach into every corner of society. The mechanics are surprisingly simple, which makes them all the more disturbing. Let's say you need $50,000 for a new car. You walk into a bank, fill out paperwork, and if approved, the bank creates that $50,000 electronically. They don't take it from someone else's account. They don't withdraw it from a vault. They simply add $50,000 to your account and $50,000 to their own books as an asset. Your promise to pay them back. In that instant, $50,000 that never existed before springs into being. But here's the catch. The bank created the $50,000 you borrowed, but they didn't create the interest you owe. Let's say that loan comes with 5% annual interest. Over the life of the loan, you'll pay back not just $50,000, but perhaps $70,000 or more. The bank created the principal, but where does that extra $20,000 come from? It has to come from money created by other loans, other debts, somewhere else in the system. This creates a mathematical impossibility at the heart of our monetary system. If all money is created as debt, but more money is owed back than was ever created, then the total amount owed will always exceed the total amount of money in existence. The system requires constant expansion, constant new borrowing, just to service the debts that already exist. It's a pyramid scheme disguised as a financial system, and we're all trapped inside it. The banks call this fractional reserve banking, but that term obscures what's really happening. It suggests they keep a fraction of deposits in reserve and lend out the rest. But modern banks don't work that way. They don't need your deposits to make loans. They create the loan first, and the deposit appears as a result. The money supply grows every time someone goes into debt, and it shrinks every time debt is paid off. Your mortgage isn't just a personal financial obligation. It's literally creating the money supply. This system emerged gradually over centuries, but it became dominant only in the 20th century when governments abandoned gold-backed currencies and embraced what economists call fiat money. The word fiat means let it be done, money created by decree, backed by nothing more than faith in the institutions that issue it. And those institutions, increasingly, are not governments, but private banks with the power to create money whenever they approve a loan. The transformation was subtle but profound. Under gold-backed systems, money was scarce because gold was scarce. Banks could only lend what they actually had. But when money became debt, scarcity became artificial, controlled not by natural limits, but by the willingness of banks to lend and borrowers to borrow. Money could expand infinitely, as long as someone was willing to go into debt to create it. The genius of this system, from the bank's perspective, is that they collect interest on money they never had to begin with. They take no real risk. If you default, they seize your collateral, which was purchased with money they create you paid at no cost. If as promised, they collect years of interest payments on funds they conjured from nothing. Either way, they profit from money that exists only because you agreed to owe it. For governments, the system offers a different kind of convenience. Instead of raising taxes or cutting spending to balance budgets, they can simply borrow new money into existence. National debts aren't just numbers on a ledger. They represent the total amount of money that government's having. The larger created through borrow the debt, the more money exists in the economy. Paying off the debt would actually shrink the money supply, which explains why no major government has ever seriously attempted to eliminate its national debt. This creates a perverse incentive structure where debt becomes desirable, even necessary, for the system to function. Economic growth depends on an expanding money supply, which depends on expanding debt. Without new borrowers, the money supply stagnates. Without new debt, the economy contracts. The system requires us to borrow ourselves into prosperity, even though that prosperity is built on promises that become harder to keep with each passing year. The consequences ripple through every layer of society in ways most people never recognize. When banks create money through lending, they don't distribute it evenly across the population. The newly created money flows first to those who can qualify for large loans: corporations, real estate developers, wealthy individuals with assets to pledge as collateral. These first recipients get to spend the new money before prices have adjusted to its existence. They buy properties, stocks, and businesses at today's prices with tomorrow's inflated money supply. By the time this newly created money trickles down to wages and salaries, prices have already begun to rise. The mechanic, the teacher, the nurse, they feel the inflation, but never receive the benefit of the fresh money creation. They're paying higher prices for housing, food, and energy, while the wealthy who borrowed first have already converted their debt into appreciating assets. It's a wealth transfer mechanism disguised as a lending system. This explains why asset prices, real estate, stocks, commodities, tend to rise faster than wages over long periods. Every time money is created through debt, it inflates the prices of things that wealthy borrowers buy first. The working class sees their purchasing power eroded while being told the economy is growing. Growth measured in dollars becomes meaningless when the dollars themselves are constantly being diluted through new debt creation. The housing market provides the clearest example. When banks make it easier to borrow for mortgages, they create more money chasing the same number of houses. Home prices rise not because houses became more valuable, but because more money was created to bid on them. Young families find themselves priced out not by natural scarcity, but by artificial money creation that benefits those who already own property. The debt that creates new money to buy houses simultaneously makes houses unaffordable for those who don't already have them. Central banks, despite their official mandate to control inflation and unemployment, are actually trapped by this system. When they raise interest rates to combat inflation, they make borrowing more expensive, which slows money creation and can trigger economic contraction. When they lower rates to stimulate growth, they accelerate money creation and fuel asset bubbles. They're not managing the economy, they're managing the side effects of a monetary system that creates money through debt. The 2008 financial crisis revealed the ultimate fragility of this arrangement. When borrowers began defaulting on mortgages, the money that had been created to fund those loans didn't disappear. It remained in the system, while the collateral backing it lost value. Banks faced insolvency not because they lost money they had, but because the money they created was no longer backed by assets worth its face value. The solution was to create even more money through bailouts and quantitative easing, pushing the fundamental contradictions further into the future. Quantitative easing, the practice of central banks creating money to buy government bonds and other securities, represents the final abandonment of any pretense that money represents real wealth. When the Federal Reserve creates trillions of dollars electronically to purchase bonds, it's not investing money it earned or saved. It's creating new money that dilutes the value of every existing dollar, transferring wealth from savers to borrowers and from the prudent to the reckless. This system requires perpetual growth, not because growth is inherently good, but because mathematical necessity demands it. If the total debt in the system grows faster than the money supply, which it must, since money is created as principal but interest is owed on top, then either new debt must be created to service old debt, or defaults will shrink the money supply and trigger deflation. There's no equilibrium, no stable endpoint. The system demands exponential expansion or faces collapse. Small businesses and individuals feel this pressure most acutely. They must compete for customers and employees using money that loses value over time, while large corporations can access newly created money directly through bond markets and bank lending. A small restaurant owner watches their costs rise due to monetary inflation while competing against chains that finance expansion with cheap debt. The independent contractor sees their savings eroded while corporations use borrowed money to buy back their own stocks. The consequences run deeper than higher prices or inflated assets. This debt-based money system shapes the psychology of entire societies, creating cultures addicted to borrowing and spending rather than saving and producing. When money loses value by design, saving becomes foolish and speculation becomes rational. When debt creates money, borrowers are rewarded and savers are punished. The system inverts the natural relationship between prudence and recklessness. Consider what this means for retirement planning. Workers are told to save for decades in accounts denominated in dollars that are systematically debased through new debt creation. Their pension funds and 401k accounts hold bonds that pay interest in currency worth less each year. Meanwhile, those who borrowed to buy real assets decades ago find their debts inflated away while their properties appreciate. The saver loses, the borrower wins, and society learns the wrong lessons about financial responsibility. The international implications are even more devastating. When the United States exports its debt-based dollars to the world, it exports inflation along with them. Developing nations hold dollar reserves and price their commodities in dollars, making them vulnerable to American monetary policy decisions. When the Federal Reserve creates money, it doesn't just affect American prices. It affects global markets, forcing other nations to create their own money in response, or watch their currencies appreciate beyond their export industry's ability to compete. This creates a form of financial colonialism where developing nations must constantly accumulate dollar debts to participate in global trade, making them perpetually dependent on a monetary system they cannot control. Their real resources, oil, minerals, agricultural products, flow to dollar-holding nations in exchange for currency that can be created at will. The wealth of the world concentrates in the hands of those who control the printing press. But perhaps the most insidious effect is how this system corrupts the relationship between work and reward. In a sound monetary system, productive work creates value that can be stored and exchanged over time. People save the fruits of their labor and trade them for the fruits of others' labor. But when money is created through debt rather than production, the connection between work and wealth breaks down. Financial engineering becomes more profitable than actual engineering. Moving money around becomes more valuable than making things. The smartest minds of each generation are drawn not to solving humanity's greatest challenges, but to gaming a financial system that rewards complexity over productivity. Brilliant mathematicians and programmers build algorithms to extract profits from microsecond trading advantages rather than developing technologies to improve human life. The debt money system redirects human talent toward increasingly elaborate forms of wealth extraction rather than wealth creation. Young people entering this system face a cruel choice: participate in the debt-fueled asset bubble or be left behind. They must borrow enormous sums to buy homes at inflated prices or remain renters forever. They must chase returns in speculative markets or watch their savings lose purchasing power. The system forces everyone to become speculators, whether they want to or not, because holding money itself is a guaranteed losing strategy. Even those who understand the system find themselves trapped by it. You cannot opt out of using dollars. You cannot avoid the effects of monetary inflation. You cannot escape a system that creates the very money you must use to survive. Knowledge of the trap doesn't free you from the trap. It only makes the bars more visible. Yet understanding this system is the first step toward protecting yourself within it. Once you see that every dollar is born in debt, you begin to understand why certain assets appreciate while others stagnate, why debt levels never decrease, why financial crises recur with predictable regularity. You stop asking why housing is unaffordable and start asking how many new dollars were created to bid on houses. You stop wondering why your savings lose value and start understanding that their debasement is not a bug in the system. It's a feature. The implications extend beyond personal finance into the realm of societal organization. A monetary system based on ever-expanding debt requires ever-expanding consumption to service that debt. Environmental destruction becomes not just profitable but necessary to keep the system functioning. Planned obsolescence, consumer culture, and the endless pursuit of growth are not accidents. They're requirements of a system that dies without constant expansion. This debt money system also explains why governments around the world struggle with similar problems regardless of their political systems. Whether capitalist or socialist, democratic or authoritarian, every nation using debt-based currency faces the same mathematical constraints. Their political differences matter less than their monetary architecture. The system shapes the society more than the society shapes the system. The solution is not to reform the existing system, but to recognize its fundamental impossibility. You cannot create sustainable prosperity by borrowing it into existence. You cannot build lasting wealth on the foundation of perpetual debt. You cannot maintain social stability when the money itself is unstable. Every dollar born in debt carries within it the seeds of its own destruction. History offers no examples of debt-based monetary systems surviving indefinitely. The mathematics always catches up. The exponential growth of debt eventually outpaces the linear growth of productive capacity. The weight of accumulated promises becomes impossible to bear. The illusion of wealth created through borrowing eventually collides with the reality of resources that must be produced, not conjured. For individuals, the path forward lies not in fighting the system, but in understanding it well enough to navigate it. Hold assets that cannot be created through debt, develop skills that create real value, build relationships and communities that can function regardless of monetary chaos. Learn to distinguish between genuine wealth and financial abstractions. The system may be rigged, but those who understand the rules can still protect themselves and their families. The hidden truth about money is not that it's complicated, it's that it's too simple for most people to believe. Every dollar is born in debt because that's the only way it can be born under the current system. That debt grows faster than the money supply because that's how the mathematics work. The system requires infinite growth on a finite planet because that's what exponential functions demand. These are not mysteries to be solved, but realities to be acknowledged. The question is not whether this system will end, it's how and when. Every debt-based monetary system in history has eventually collapsed under the weight of its own contradictions. The only uncertainty is whether the collapse will be gradual and managed, or sudden and chaotic, and what will replace it when the illusion finally breaks. Until then, every dollar you earn, save, or spend carries with it the DNA of debt. Every transaction you make participates in a system that creates money through promises to pay. Every financial decision you face is shaped by the reality that your money is not a store of value, but an IOU in an elaborate chain of IOUs that stretch back to the moment someone first promised to pay back money that never existed until they asked for it. Now, you know the hidden truth. Every dollar is born in debt, and that birth shapes everything about how money flows through society. The question is what you'll do with that knowledge. Because understanding the system is the first step toward surviving it. And survival is the first step toward building something better. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. The truth has been hidden long enough.